Investing for the long term involves creating a well-diversified portfolio designed to provide you with the appropriate levels of risk and return under a variety of market scenarios. But even after designing the right portfolio, no one can predict or control what returns the market will actually provide. It is important not to expect too much and to be careful when figuring out what to expect. Nobody can tell you what a reasonable rate of return is without having an understanding of you, your goals, and your current asset allocation. The adage, "If you don't know where you are going, you will probably end up somewhere else," is as true of investing as anything else. Everything from the investment plan to the strategies used, the portfolio design, and even the individual securities can be configured with your life objectives in mind. Too many investors focus on the latest investment fad or on maximizing short-term investment return instead of designing an investment portfolio that has a high probability of achieving their long-term investment objectives. The only way to create a portfolio that has the potential to provide appropriate levels of risk and return in various market scenarios is adequate diversification. Often investors think they can maximize returns by taking a large investment exposure in one security or sector. But when the market moves against such a concentrated position, it can be disastrous. Too much diversification and too many exposures can also affect performance. The best course of action is to find a balance. Seek the advice of a professional advisor. There are two time frames that are important to keep in mind: the short term and everything else. If you are a long-term investor, speculating on performance in the short term can be a recipe for disaster because it can make you second-guess your strategy and motivate short-term portfolio modifications. But looking past near-term chatter to the factors that drive long-term performance is a worthy undertaking. If you find yourself looking short-term, refocus. The fundamental principle of investing is to buy low and sell high. So why do so many investors do the opposite? Instead of rational decision-making, many investment decisions are motivated by fear or greed. In many cases, investors buy high in an attempt to maximize short-term returns instead of trying to achieve long-term investment goals. A focus on near-term returns leads to investing in the latest investment craze or fad, or investing in the assets or investment strategies that were effective in the near past. Either way, once an investment has become popular and gained the public's attention, it becomes more difficult to have an edge in determining its value.
Trading too much and too often. When investing, patience is a virtue. Often it takes time to gain the ultimate benefits of an investment and asset allocation strategy. Continued modification of investment tactics and portfolio composition can not only reduce returns through greater transaction fees, it can also result in taking unanticipated and uncompensated risks. You should always be sure you are on track. Use the impulse to reconfigure your investment portfolio as a prompt to learn more about the assets you hold instead of as a push to trade. Paying too much in fees and commissions. Investing in a high-cost fund or paying too much in advisory fees is a common mistake because even a small increase in fees can have a significant effect on wealth over the long term. Before opening an account, be aware of the potential cost of every investment decision. Look for funds that have fees that make sense and make sure you are receiving value for the advisory fees you are paying. Focusing too much on taxes. Although making investment decisions on the basis of potential tax consequences is a bit like the tail wagging the dog, it is still a common investor mistake. You should be smart about taxes. Tax loss harvesting can improve your returns significantly, but it is important that the impetus to buy or sell a security is driven by its merits, not its tax consequences. Not reviewing investments regularly. If you are invested in a diversified portfolio, there is an excellent chance that some things will go up while others go down. At the end of a quarter or a year, the portfolio you built with careful planning will start to look quite different. Don't get too far off track. Check in regularly, at a minimum once a year, to make sure that your investments still make sense for your situation, and importantly, that your portfolio doesn't need rebalancing. Taking too much, too little, or the wrong risk. Investing involves taking some level of risk in exchange for potential reward. Taking too much risk can lead to large variations in investment performance that may be outside your comfort zone. Taking too little risk can result in returns too low to achieve your financial goals. Make sure that you know your financial and emotional ability to take risks and recognize the investment risks you're taking, not knowing the true performance of your investments. It is shocking how many people have no idea how their investments have performed. Even if they know the headline result or how a couple of their stocks have done, they rarely know how they have performed in the context of their portfolio. Even that is not enough. You have to relate the performance of your overall portfolio to your plan to see if you are on track after accounting for costs and inflation. Don't neglect this. How else will you know how you are doing?
Reacting to the media, there are plenty of 24-hour news channels that make money by showing tradable information. It would be foolish to try to keep up. The key is to parse valuable information out of all the noise. Successful and seasoned investors gather information from several independent sources and conduct their own proprietary research and analysis. Using the news as a sole source of investment analysis is a common investor mistake because by the time the information has become public, it has already been factored into market pricing. Chasing yield, a high-yielding asset, is a very seductive thing. Why wouldn't you try to maximize the amount of money you get back? Simple. Past returns are no indication of future performance, and the highest yields carry the highest risks. Focus on the whole picture. Don't get distracted while disregarding risk management. Trying to be a market timing genius, market timing is possible, but very, very, very hard. For people who are not well trained, trying to make a well-timed call can be their undoing. Not doing due diligence. There are many databases in which you can check whether the people managing your money have the training, experience, and ethical standing to merit your trust. Working with the wrong advisor. An investment advisor should be your partner in achieving your investment goals. The ideal financial professional and financial service provider not only has the ability to solve your problems, but shares a similar philosophy about investing and even life in general. The benefits of taking extra time to find the right advisor far outweigh the comfort of making a quick decision. Letting emotions get in the way, investing brings up significant emotional issues that can impede decision-making. Do you want to involve your spouse in planning your finances? A good advisor will be able to help you construct a plan that works no matter what the answers to these questions are. Forgetting about inflation, most investors focus on nominal returns instead of real returns. This focus means looking at and comparing performance after fees and inflation, even if the economy is not in a massive inflationary period. Neglecting to start or continue, individuals often fail to begin an investment program simply because they lack basic knowledge of where or how to start. Likewise, periods of inactivity are frequently the result of lethargy or discouragement over previous investment losses. Investment management is a discipline that is not overly complex, but requires continual effort and analysis in order to be successful. Not controlling what you can, people like to say that they can't tell the future, but they neglect to mention that you can take action to shape it. You can't control what the market will bear, but you can save more money. Continually investing capital over time can have as much influence on wealth accumulation as the return on investment.
Determined level at which you'll close a trade to limit your potential losses. Imagine it as a safety net, protecting your capital from a significant fall. To establish an effective stop loss, you need to consider factors like market volatility and the size of your investment. It's not about predicting the market, but mitigating risks. Let's say the market takes an unexpected turn. Your stop loss will trigger, and your trade will close, minimizing your losses. By setting a stop loss, you protect your capital and prepare for any market volatility. Now, let's move on to hedging against losses. In the world of trading, hedging is akin to an insurance policy. It's a strategy designed to protect your investments from unfavorable market movements. Imagine you're on a boat in the middle of a stormy sea. Hedging is like throwing out an anchor to hold your position steady, even when the waters are choppy. So, how does it work? By strategically opening positions that have the potential to gain value when your other investments are losing. This way, If the market takes an unexpected turn, your losses on one position can be offset by gains on another. It's a balancing act, a way of spreading risk and creating a more stable trading experience. Effective hedging requires careful planning and a deep understanding of the market. It's not about making predictions, but about preparing for various outcomes. Remember, the goal is not to eliminate risk, but to manage it. Hedging is a strategic tool to mitigate risks and safeguard your investments. Scene script. Next up, we focus on diversification. Picture a world where you've placed all your eggs in one basket and then that basket tips over. That's what it's like to invest all your resources into one currency pair. Now, imagine you'd spread those eggs across several baskets. If one tips over, the others are still safe and sound. That's the power of diversification in Forex trading. By spreading your investments across various currency pairs, you're reducing the impact of individual market movements. No one currency pair can make or break your portfolio. Because the Forex market is influenced by a multitude of factors, having a diversified portfolio can help cushion the blow of unexpected market changes. Think of diversification as your safety net. It's a strategy that doesn't just protect your capital, but also offers the potential for steady growth. Diversification is a powerful strategy that can enhance your trading performance. Let's discuss the importance of adjusting your stop-loss levels. In the ever-fluctuating world of Forex trading, adaptability is your best ally. This is where stop-loss adjustments come in. As market conditions change, so should your stop-loss orders. By doing so, you can better protect your investments from sudden market downturns. But remember, it's not just about minimizing losses. Adjusting your stop-loss orders can also help maximize your profits. When the market is in your favor, trailing your stop-loss can lock in your profits and let your winning trades run. Remember, effective management of your stop-loss orders is not about predicting the market. It's about responding to the market. Effective management of your stop-loss orders is key to a successful trading strategy. Now, let's tackle a common pitfall: overtrading. Overtrading, ladies and gentlemen, is similar to a dog chasing its tail. A lot of action, but not much progress. When you're caught in the cycle of buying and selling too frequently, it's easy to lose sight of your original plan and purpose. So, how do you avoid falling into this trap? The answer is discipline. Start by creating a well-thought-out trading plan. Define your goals, your risk tolerance, and most importantly, stick to the plan. Don't let the excitement of the market sway you off your path. Next, set realistic targets. Remember, Rome wasn't built in a day, and neither will your trading empire be. Lastly, adhere to your strategy. It's tempting to jump ship at the sight of a potentially profitable trade, but consistency is the bedrock of long-term success. Remember, quality over quantity is the key to a successful trading journey. Keeping up with the latest market news is crucial. With the dynamic nature of Forex trading, being informed about current events and economic indicators is essential. It's like having a compass in the vast sea of market trends, guiding your trading decisions. Consider the news as your window to the world of Forex. It throws light on the economic health of countries, influencing the value of their currencies. Moreover, it provides insights into potential market movements, helping you anticipate changes and adapt your strategies accordingly. Remember, knowledge is power. By staying updated with market news, you're not just reacting to the market, you're anticipating it. It's like having a sneak peek into the future, providing you with opportunities to make strategic decisions. Staying informed allows for strategic decision-making and keeps you ahead of the game. Let's talk about avoiding whipsaws. Whipsaws occur when the market makes a sharp move in one direction, then swiftly reverses, creating a whip-like motion. These erratic price movements can mislead traders into entering or exiting positions prematurely, leading to potential losses. So, how do we avoid them? Firstly, avoid knee-jerk reactions to sudden market movements. Patience is key. Secondly, use technical analysis tools like moving averages to smooth out short-term volatility and identify underlying trends. Lastly, consider using a delay filter, waiting for the price to move a certain percentage or number of pips before confirming a trend. Identifying and avoiding whipsaws can safeguard your trades from unnecessary losses. Next, we delve into the art of risk management. This art is a blend of strategy and knowledge, a crucial skill for every trader. Let's start with position sizing. It's the process of deciding how much of your capital to invest in a particular trade. By allocating a smaller portion of your capital to each trade, you can reduce your potential losses. Then we have leverage. While offering the potential for larger gains, high leverage can also magnify losses. So, it's essential to use it judiciously. Lastly, let's talk about setting realistic risk-to-reward ratios. This ratio is a trader's potential reward for every unit of risk taken. Aiming for a higher reward-to-risk ratio can lead to greater profitability in the long run, even if you have more losing trades than winning ones. Mastering risk management techniques can protect your trading capital and enhance your profitability. Let's talk about using indicators. In the world of Forex trading, indicators serve as your compass, guiding you through the choppy waters of the market. These powerful tools in technical analysis can provide you with valuable insights into market trends and potential entry or exit points. Some of the most widely used indicators are the moving average, relative strength index, and Bollinger Bands. The moving average helps you identify a market's trend direction. The relative strength index measures the speed and change of price movements, and Bollinger Bands provide a relative definition of high and low prices. Each of these indicators is unique and offers different perspectives on the market. Understanding and using indicators can give your trading strategy an edge. Finally, we address the issue of emotional trading. Emotions, if unchecked, can become the invisible saboteur in your trading journey. They can cloud your judgment, leading you down the perilous path of impulsive decision-making. Now, how do we combat this? The first step is to recognize this potential pitfall and develop a disciplined trading plan. This plan should be rooted in thorough analysis, not fleeting feelings. It's also helpful to set realistic targets and maintain a consistent trading routine. By doing so, you transform trading from a game of chance into a structured process. So keep your emotions in check and your analysis sharp. By avoiding emotional trading, you can make more informed, objective decisions for consistent profitability.
Avoid making hasty investment decisions to protect your money. The stock market can be volatile, and making impulsive investment choices can lead to financial losses. Always take the time to thoroughly research and analyze potential investments before committing your hard-earned money. It is important to understand the technical terminology and the basics of stock market trading. To navigate the stock market successfully, familiarize yourself with essential terms such as dividends, EPS, PE ratio, and market capitalization. Developing a solid understanding of these concepts will enable you to make more informed decisions and assess the true value of a company. You must define your risk profile and investment goals clearly to succeed. Every investor has a unique risk tolerance level and investment objectives. Determine the amount of risk you are comfortable with and set clear goals for your investment journey. This will help you make appropriate investment choices that align with your risk profile and desired outcomes. Investing is a better option for a new investor. If you cannot give enough time to the stock markets, it is advisable to invest in mutual funds. For new investors or those with limited time to dedicate to stock market research, mutual funds can be an ideal option. By investing in mutual funds, you can benefit from professional management and diversification across a range of stocks. This helps reduce your risk exposure and provides you with a simple yet effective investment solution. Start analyzing and identifying potential stocks. Remember to avoid making emotional decisions and derivative trading. To make intelligent investing choices, conduct thorough research on companies, industry trends, and market conditions. Build a solid foundation by analyzing financial statements, evaluating competitive advantages, and understanding growth prospects. Avoid making emotional investment decisions driven by market sentiment, and refrain from engaging in derivative trading unless you have a deep understanding of the associated risks. Established companies are less likely to lose their ground. It is advisable to keep stocks of these companies in your portfolio. Investing in established, financially stable companies can provide a level of stability and mitigate risk. These companies have a proven track record of success and are less likely to suffer significant downturns. Consider including stocks of such companies in your portfolio to enhance its overall resilience. Congratulations! You have learned valuable strategies for intelligently investing in the stock market. By avoiding hasty decisions, understanding the fundamentals, defining your risk profile, considering investing in mutual funds, analyzing potential stocks, and focusing on established companies, you can safeguard your money and pave the way for long-term financial success. Stay informed, stay focused, and make smart investment choices.